In this video, we're going to break down the one super semiconductor stock that is quietly obliterating Nvidia, AMD, and Broadcom in 2026. This stock is outperforming these biggest names in tech right now, and it is not even a chip maker. By the end, you will understand why this company is suddenly at the center of the AI revolution, why its growth is accelerating faster than expected, and whether it is still a smart buy today. Right now, the most powerful companies in the world are locked in a race to build faster, smarter, and more scalable computing systems. Behind the scenes, there is an entirely different layer of infrastructure that makes all of this possible. This is the layer that determines how fast information moves, how efficiently systems communicate, and how far AI can actually scale over the next decade, and that is exactly where this company dominates. The company is Corning, ticker symbol GLW. Now, before we even talk about growth or stock performance, you need to understand what makes this business so important right now. Corning is not new. This is a company that has been around for 175 years. It has been involved in some of the most important technological transitions in history. From early glass innovations to components used in modern consumer electronics, Corning has consistently positioned itself as a supplier of critical materials. But today, the story is completely different. Corning sits at the center of a bottleneck that most investors are not paying attention to. Data movement. Everyone talks about processing power when it comes to AI. Faster chips, better GPUs, more compute, but none of that matters if the data cannot move fast enough between systems, and that is exactly the problem data centers are trying to solve right now. Traditional infrastructure relies heavily on copper cables to connect servers, processors, and storage systems. Copper has limits, it loses signal over distance, it generates heat, it cannot keep up with the speed requirements of modern AI workloads. Fiber optic technology solves that problem, and Corning is one of the leading innovators in fiber optics. This is where the opportunity becomes massive. As AI models grow more complex, the amount of data being processed and transferred is exploding. Data centers are being forced to upgrade their entire communication infrastructure just to keep up. That upgrade cycle is not optional. It is necessary for AI to function at scale. Corning's fiber solutions allow data to travel faster, over longer distances, with minimal loss. That means higher efficiency, better performance, and lower long-term costs for operators. Now here is the key innovation that is driving demand right now. Corning recently introduced a product called multi-core fiber. This technology essentially packs 4 cores into a single strand of fiber. That means you can achieve the same performance with 75% fewer cables. Think about what that does for a data center. Less physical infrastructure, lower installation costs, reduced complexity, higher speed. This is not a small improvement, this is a step change in how data centers are designed, and because of that, demand is exploding. Now let's connect this to the stock. Corning has surged 74% this year alone. That is not just strong performance, that is market leadership. It has outperformed many of the biggest names in tech during the same period, but this is not driven by hype. It is driven by real contracts. One of the biggest catalysts came when a major hyperscale company committed to buying $6 billion worth of Corning's optical fiber over the next few years. To support that demand, Corning is even building a dedicated manufacturing facility. That tells you everything you need to know about scale, and it does not stop there. Corning recently announced 2 additional long-term agreements with hyperscale customers. These deals are expected to be similar in size and scope, meaning they could also be worth billions. This is not one-off demand. This is a structural shift in how data centers are being built. Now let's talk about the numbers, because this is where the story really starts to validate itself. In the first quarter of 2026, Corning's optical communications segment generated $1.8 billion in revenue. That represents 36% growth year over year. That is not just strong, it is accelerating. Just 1 quarter earlier, the growth rate was 35%. So not only is demand high, it is increasing. This segment alone is now the largest contributor to Corning's overall business. Across all divisions, the company generated $4.3 billion in core revenue for the quarter. But here is the most important number: profit. Corning's enterprise communications segment generated $387 million in net income during the quarter. That is a 93% increase compared to the previous year. 93%. That is what real operating leverage looks like, and it gets even more interesting. This one segment accounted for more than half of Corning's total core net income, which came in at $612 million. In other words, AI-driven demand is not just boosting revenue, it is transforming the entire profitability structure of the company. This is what investors look for, not just growth, but profitable growth. Now let's step back and talk about the long-term picture, because that is where Corning becomes even more compelling. The CEO has indicated that the market for data center optical fiber could triple in the coming years due to AI demand. Think about that. If the market triples and Corning maintains or expands its position within that market, the growth potential is enormous. This is not a short-term trend. This is the early stage of a multi-year infrastructure build-out. And Corning is supplying a critical component of that build-out. That creates a durable competitive advantage, not just because of technology, but because of relationships, manufacturing scale, and deep integration into customer systems. Now let's talk valuation. Over the past 4 quarters, Corning has generated adjusted earnings of $2.69 per share. That puts the stock at a price-to-earnings ratio of around 57. At first glance, that might seem expensive, but here is where forward expectations matter. Wall Street expects earnings to grow to around $3.94 per share by 2027. Based on that, the forward price-to-earnings ratio drops to about 38. That is a very different picture. It suggests that while the stock is not cheap today, there is room for upside as earnings catch up with the valuation. And this is where long-term investors start to pay attention. Because when you have a company with accelerating revenue, expanding margins, and a massive market opportunity ahead, valuation becomes a function of growth. Now here's the key question. Is this growth sustainable? The answer depends on one thing: AI demand. If AI continues to scale at the current pace, data center infrastructure will need to expand rapidly. That means more fiber, more connectivity, and more upgrades. And that plays directly into Corning's strengths. But if AI demand slows down, or if data center investment cycles become more volatile, growth could normalize. So while the long-term trend is strong, there are still risks. And we are going to break those down in detail in part 2. Because understanding the risks is what separates smart investors from reactive ones. Before we get there, here is the bottom line so far. Corning is not a typical AI stock. It is an infrastructure play. It does not rely on hype. It relies on necessity. And right now, that necessity is growing faster than most people realize. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's talk about what could go wrong, because no matter how strong a growth story looks, the best investors always look at the downside first. And with Corning, there are a few critical risks you need to understand before making any decision. The first risk is concentration. A large portion of Corning's recent growth is coming from a relatively small number of hyperscale customers. These are massive clients placing multi-billion-dollar orders, which is great for revenue visibility. But it also creates dependency. If even one of these customers delays spending, renegotiates contracts, or shifts strategy, it could impact Corning's growth trajectory. This is the trade-off that comes with large deals. High upside, but also higher exposure. The second risk is technological disruption. Right now, fiber optics is the best solution for high-speed data transmission at scale. But technology evolves. If a new method emerges that significantly improves performance or reduces cost beyond what fiber can offer, Corning could face competition from entirely new categories. This is not an immediate threat, but it is something long-term investors need to keep in mind. The third risk is cyclical spending. Even though AI is a long-term trend, the investments required to build data centers are massive. Companies may not spend at a constant rate every year. There could be periods of rapid expansion followed by slower investment phases. If Corning's growth is heavily tied to these cycles, revenue could become more volatile over time. Now let's talk about expectations. The stock has already moved up significantly. A 74% gain in a single year sets a high bar for future performance. That means even if the company continues to grow, the stock may not move at the same pace. This is where many investors get caught off guard. They assume past performance will continue indefinitely. But markets do not work that way. At some point, growth needs to justify valuation. And that brings us back to the key question: is Corning still a buy? The answer depends on how you think about time. If you are looking for a quick gain, this may not be the ideal setup. The stock has already had a strong run, and short-term volatility is always possible after such moves. But if you are thinking long-term, the story is different. Corning is positioned at the intersection of one of the most important trends of our time. It is not competing in crowded markets. It is supplying a critical component that enables the entire system to function. That gives it staying power. And more importantly, it gives it pricing power. We already saw evidence of that in the latest earnings. Strong demand allowed Corning to increase margins significantly, driving a 93% increase in net income for its key segment. That is not easy to replicate. Now here is another angle to consider. Most investors focus on companies that are visible, the ones making headlines, the ones everyone is talking about. but some of the best opportunities come from companies operating behind the scenes. The ones building the infrastructure, the ones solving the bottlenecks, the ones that quietly benefit from every dollar invested in the broader ecosystem. Corning fits that profile perfectly. It does not need to win the AI race. It just needs to supply the tools that make the race possible. And as long as demand for those tools continues to grow, the business has a clear path forward. Now let's bring everything together. Corning has a proven history, a strong position in a critical industry, accelerating growth driven by AI demand, and a clear long-term opportunity as data center infrastructure expands. It also has risks related to customer concentration, technological change, and cyclical spending. But when you weigh those factors, the long-term case remains compelling. This is not a hype-driven story, this is an infrastructure story, and infrastructure tends to compound quietly over time. So if you are looking for exposure to AI without chasing the most obvious names, Corning offers a different angle, a more subtle but potentially powerful one. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now here is a question for you. Do you think companies that build the infrastructure behind AI will outperform the companies that get all the attention, or do you believe the biggest gains will always come from the most visible players? Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.